Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Ever considered broadening your investment horizons beyond traditional stocks and bonds? You're not alone. Many investors are looking for ways to diversify their portfolios and protect their wealth from inflation's bite. That's where commodities ETFs like DBC come into play. Commodities ETFs offer a simple way to invest in a range of essential resources, from agriculture and energy to precious metals. They've become increasingly popular, especially when economic changes make other investments less predictable. If you're looking to understand how these funds work and how they might fit into your financial strategy, you're in the right place. What are commodities ETFs and how do they work? Commodities ETFs are investment funds that trade on stock exchanges, much like company stocks. They track the price movement of specific commodities or a group of commodities. Instead of owning physical gold bars or barrels of oil, you own shares in a fund that aims to reflect the performance of these raw materials. These ETFs offer an easy way to get exposure to the commodities market without the complexities of direct ownership. Understanding the underlying assets in commodities ETFs. Commodities ETFs get their value from different types of raw materials. Knowing what these are helps you understand how an ETF's price might change. Energy commodities. These include items like crude oil and natural gas. Their prices often react to global supply and demand, political stability, and even weather patterns. For example, a harsh winter can boost natural gas prices. Precious metals. Think gold and silver. These are often seen as safe investments, especially during times of economic uncertainty or high inflation. Their value can climb when currency values fall or geopolitical risks rise. Industrial metals. This category covers metals like copper and aluminum. Their prices usually reflect the health of the global economy. Strong industrial activity and construction drive demand for these materials. Agricultural products. Corn, wheat, and soybeans fall into this group. Weather conditions, crop yields, and global food demand are major factors affecting their prices. A drought in a major farming region could significantly impact these commodities. Each of these categories has unique drivers. An ETF holding energy commodities will behave differently from one focused on precious metals. This diversity is what makes commodities ETFs interesting for portfolio diversification. Futures contracts and their role in commodity ETF performance. Most commodities ETFs do not hold the physical commodity itself. Imagine the logistics of storing massive amounts of oil or tons of wheat. Instead, they use futures contracts. A futures contract is an agreement to buy or sell a commodity at a predetermined price on a specific future date. This is how ETFs gain exposure to commodity prices. Here is how futures contracts impact ETFs. Exposure to price movements. When the price of the underlying commodity moves up, the value of the futures contract the ETF holds typically increases. This translates to a higher ETF share price. Roll yield. Futures contracts have expiration dates. As a contract nears expiration, the ETF rolls its position into a new contract with a later expiration date. This rolling process can impact returns. Contango. This happens when future prices are higher than current spot prices. When an ETF rolls its contracts in a contango market, it sells cheaper expiring contracts and buys more expensive new ones. This can lead to a negative roll yield, dragging down long-term returns. Backwardation. This is the opposite, where future prices are lower than current prices. In a backwardated market, the ETF sells more expensive expiring contracts and buys cheaper new ones. This can result in a positive roll yield, boosting returns. Understanding contango and backwardation is key for anyone considering commodities ETFs, especially for holding them over longer periods. These market conditions can significantly influence how well the ETF tracks the actual spot price of the commodity. Key benefits of investing in commodities ETFs. Investing in commodities ETFs offers distinct advantages that can strengthen your overall financial strategy. Beyond just adding another asset type, these funds can provide specific benefits like diversifying your holdings, protecting against inflation, and offering an easy way to access a complex market. Let's explore why these benefits make commodities ETFs a compelling addition to many portfolios. Portfolio diversification through commodity exposure. Think about your investment portfolio like a sports team. You wouldn't want a team made up only of pitchers, right? Similarly, having a mix of different investments helps your portfolio perform better in various market conditions. This is where commodities shine. Historically, commodities often behave differently than traditional assets like stocks and bonds. When stocks might be struggling, commodity prices could be holding steady or even rising. This low correlation means that adding commodities to your mix can help smooth out your portfolio's returns. It's like having players who perform well even when others are not. This can potentially reduce your overall risk, especially during market downturns when other assets might be falling sharply. By spreading your investments across different asset classes, you build a more robust and resilient portfolio. Commodities ETFs as an inflation hedge. Inflation is like a hidden tax, slowly eroding the purchasing power of your money. Over time, your dollar just won't buy as much. This is a big concern for many investors. The good news is that commodities can act as a powerful hedge against inflation. When the cost of living goes up, the prices of raw materials often increase as well. Why? Because the cost of producing goods rises, and those costs are passed on through the supply chain. For example, higher energy prices directly impact transportation and manufacturing costs. This means that as inflation pushes prices higher, the value of your commodities ETF holdings might also climb, helping to preserve your purchasing power. Looking back, we've seen strong correlations between rising commodity prices and periods of high inflation. This makes commodities ETFs a valuable tool for protecting your wealth from inflationary pressures. That's it for part 1. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.